Welcome to Ask Credit Coach. On this week's episode, I have my good friend, Gabriel Mendoza. But before we get started, here's a little disclaimer. You're a loan officer. I work with a lot of loan officers that refer me to business with consumers that want to buy a home. So this is in no way to endorse or promote your services. You're here to talk about the benefits of having good credit when buying a home. And I myself hope one day all my referral partners could be here one day as well.
Definitely.
Okay.
Yes.
So Gabriel, I want to talk about the process of maybe what are the first steps when someone says, you know what, hey, I want to buy a home.
So the very first thing that somebody needs to do is set up a budget.
Mm-hmm.
So I understand that it sounds obvious, but you'd be surprised how many people come to me. They say that they're ready to purchase a home, but they haven't even sat down with their family in order to find out what a comfortable payment means to them.
Yeah. Sometimes the obvious is not so obvious.
Right. So we have to sit back, reflect on what comfortable payment means to them and what an affordable payment is to them.
Okay.
So the very first thing that I say is, by setting up that budget, you're going to have an idea of what your down payment would be, of the credit score that you need, of the investment that you need, and of course the funds that are needed in order to get the best possible home loan. Okay. So there's three things that the lenders or investors, banks look for, and it's basically the 3 C's of lending, which is collateral, capacity, and credit reputation, which I'm sure that you know about. So those 3 things are going to determine the type of loan and the interest rate that somebody is going to obtain.
Okay.
So my job consists of making sure that the person understands their initial investment, which is going to give them the loan amount that they're going to be owing the bank. Their interest rates would change on a daily basis. Of course, their monthly payment, which is of course the most important thing, along with the type of program. What I mean by program, I mean is it an FHA loan, a conventional loan, an adjustable loan, a fixed loan, and of course the closing costs, which a lot of people confuse with the down payment, but there's two different things. There's 2 different things. There's closing costs. The cost of obtaining the loan are different from your initial investment, the down payment, which is going to bring down the amount that you owe to the bank at the time of close.
I see.
So
I want to talk a little bit about, that was a lot of information. But buying a home, it is a lot of my clients that are referred to by lenders and realtors, their goal is to buy a home. But I want to focus a little bit on the 3rd C, which is credit, right? Because I know credit, it plays a role in everything that we do, from renting a house to buying a house to even purchasing a vehicle. But how important is having good credit when it comes to buying a home? And 2-part question, what are the difference in interest rates or loan values when it comes to someone having a good credit score and having a bad credit score? So
it's extremely important. So somebody that has a 740 FICO score for today can obtain possibly an interest rate from a 3.625 to a 3.75. Now that same person, if they were to drop their FICO score by 100 points, their interest rate would be jumping up to 4, even above 4%. And that diminishes your buying power. Because
it increases your monthly payment.
Right. So
and that's a lot of money if you're paying over 30 years, right?
Exactly. It gets thousands and thousands of dollars over a 30-year span. So what happens is that you no longer can afford the home that you really want and have to go to a less expensive home. Or if you want to purchase a home that you want, then you're going to have a higher payment. Not to mention that you may need a larger down payment, or there may be more closing costs associated with somebody that has a lesser FICO score, and a lot more prerequisites from the bank so that you obtain your loan versus somebody that has that higher FICO score.
So overall, the ultimate goal when buying a home is the higher the credit score, the better, right?
Definitely.
Yeah, that's what we tell our clients, because I know a lot of loan requirements, I just need a 580 or 620, which is good, but the rate is not going to be so attractive.
Right.
And I know that the payment could be a little bit higher. So we always here at Credit Press Solutions encourage our clients to obtain, we help them obtain the highest FICO score possible.
Right.
Let me ask you another question. What's the difference between someone maybe going online and getting the credit score and saying, here, Gabriel, right here, it shows a 720, and then you pull a FICO score, which is a lending score,
Right.
and the score is a little bit lower, a little bit higher. Can you use a credit score, or does it have to be a FICO score?
I cannot use anybody else's. So there's freecreditreport.com or Credit.
So many online companies
Right.
that give you
Those
free
are
credit
models that give the customer or a consumer an idea. But we use a tri-merge, which includes all three FICO scores, Equifax, Experian, and TransUnion. And we would use the mid-FICO score in order to determine the interest rate or the terms of the loan that the client will receive. So all those companies out there give the consumer an idea, and I'm sure that they're great, but it's not something that we can use in order to determine if someone qualifies for a home
That's
loan.
great information. Great information. Now, I don't want to break anyone's heart here, but what are some of the information on the credit report that they just ultimately can't buy a home until they're either corrected, paid, or fixed?
Most importantly, I think collections, public records, so bankruptcies, foreclosures, of course. So, but it's a difficult question to answer because it really depends on the amount of the collections. It depends on the term that the collection has been on there. It depends the type of judgment, if it's a personal judgment or a judgment that's there by an entity or a federal entity, then it makes it obviously more harder. So it's difficult.
What if an individual maybe has back taxes and has a public record that he owes to the state or the federal, and there's a balance amount owed? Can they still buy a home with that amount there, or they have to be paid?
They can still purchase a home as long as they've shown proof that they have a payment arrangement for at least 3 months in order to show the stability of a payment.
Okay.
It does make it more difficult though, and again, it is on a base by
Of course, because if that's reported down the credit report as being non-satisfied, it's affecting the credit score whatsoever, and any public record that's reported on the credit report, it's affecting them by a lot of points. Gabriel, so I understand that you might have a credit question for me, right?
I do.
Okay, great. What's your question?
A lot of consumers don't understand the importance of keeping their balances low compared to the limit that they have on the consumer debt on the credit cards. I speak to a lot of individuals that have a $5,000 limit but owe $4,900 on that account. And they say, well, Gabriel, I'm paying on time. Why would that diminish my score? Right, so if you can explain a little bit of how that works.
Yeah, that's a great question. That's where a lot of consumers don't get confused. I'll keep it very simple as I can. Making your on-time payments, even if it's the minimum payment, that's one factor. That's the payment history.
Right.
Make your payments on time, great. Now, when it comes to revolving credit, the lower your balances, the higher your credit scores. So they work counterintuitive. If your balances are high, your scores are low. If your balances are low, your scores are high. The reason why is because the credit system does not want to see your ratios, meaning your credit limit versus your debt, being over 35%. Why? Because, well, the credit cards like that for sure, right? Because the more debt you have, the more money they make off interest rate. But the credit system does not want you to live off of credit. And credit should be used as a tool to obtain a high FICO score, to be able to obtain those, that home, maybe a nicer, more convenient car. But a lot of individuals do have high balances and don't understand why the scores are low. It's because the ratios are above 35%, and most of the time they're either very close to the limit, which means that they're maxed out. If something goes wrong, most likely they're going to stop paying the credit card. And especially if they're over the credit limit, that hurts the score even more. Well, Gabriel, thank you very much for being on the show. You shared a lot of information that was very valuable to my clients. And again, disclaimer, this is in no way to promote your services. I do thank you for your time. We've been working together for about 4 or 5 years, and I do value our relationship. And again, I would love to have all of my realtors and lenders here on the show sometime in the future. If you have any credit questions, please email me at info@ihavecreditquestion.com. Thank you very much, and never mistake being busy with being productive. Have a great day.